Hi everyone, before I start this video, make sure that you join my Discord server and the link is given in the description box below. Okay, so in this video, we'll be going over A-Level Accounting 2023 October-November Paper 2-3 question number 1. This is paper 2, which consists of 4 questions. 2 of them will be of 30 marks and 2 of them will be of 15 marks. And the total time limit given for this paper is 1 hour and 45 minutes. Since question number 1 is of 30 marks, ideally you should be spending about 35 minutes in order to solve this question. And in this video as well, we'll be attempting to solve this question under 35 minutes. So without any further delay, let's get started. B Limited provided the following information for the year ended 30 September 2023. That's our closing date. We've been given information regarding debenture, administrative expenses, allowance for irrecoverable debts at 1st October 2022. So this is the opening allowance for irrecoverable debts. We have cash and cash equivalents, distribution costs, dividend paid, finance costs, inventory, other payables, other receivables. Then property, plant and equipment at 1st October 2022. This is again at the opening date. Retained earnings at 1st October 2022. Again, opening date. Revaluation reserve at 1st October 2022. Again, the opening date. And share capital as well at the opening date. Share premium at the opening date. Then we have trade payables and trade receivables. And we are told that the revaluation reserve relates to land only. Okay. The gross profit for the year ended 30 September 2023 was 321,070. The following information is also available for property, plant and equipment at 1st October 2022. So this is the accumulated depreciation at the opening date, which means that we are yet to apply the depreciation for the year. We've been given the costs for our assets as well as the accumulated depreciation as well as the depreciation method and its apportionment towards administrative expenses and distribution costs. Okay. Let's figure out the depreciation on building. Since we're not given any depreciation method for land. For building, we have 5% per annum straight line. So we just need to charge the rate of 5% to our cost of 215,000. And we are also told that there were no acquisitions or disposals of non-current assets during the year. So we do not have to worry about adjusting any new purchases or any sort of disposals during the year. So we have the cost of 215,000 times 5%. This will give the depreciation charge for the year to be 10,750. Now we repeat the same process for equipment. And it's going to be 20% per annum reducing balance. So since this is reducing balance, we first need to calculate our net book value, which is cost of 98,400. minus the accumulated depreciation of 56,900. And on this value, we need to apply the rate of 20%. This will give the depreciation on equipment to be 8,300. Let's calculate the total. That will be 10,750 plus 8,300, which results in 19,050. And we're given the apportionment as well. So 60% should go towards administrative expenses. So that's just going to be 19,050 times 60%, which results in 11,430. Since we need to apportion it to administrative expenses, we can just add it to the administrative expenses given right here. So that's 161,100 plus 11,430. Then we repeat the same process for distribution costs. That will be 19,050 times 40%, which results in 7,620. So towards our distribution cost, we can add the amount of 7,620. Okay, we're done with the depreciation. Now, the following have not yet been accounted for. On 30 September 2023, land was revalued at 80,000. Okay, previously, our valuation of land is at 95,000. Now it's 80,000, which means that there has been a revaluation downwards. Okay. And this is of 95,000 minus 80,000, which is 15,000. And remember that revaluation downwards is just negative revaluation, which means that we need to subtract this amount from our revaluation reserve. Okay, so revaluation reserve is right here at the amount of 10,000. But remember, we have to subtract 15,000. If we subtract 15,000 from 10,000, our revaluation reserve will show a negative balance. But we cannot have a negative balance reserve. That is why we can only subtract 10,000 from our revaluation reserve And the remaining 5,000 should be subtracted from our retained earnings. So that will be minus 5,000 right here. This is the adjustment for the revaluation downwards. Now we have a bonus issue of 1 ordinary share for every 10 shares held was made. Okay, so for 10 ordinary shares, we are providing 1 new bonus shares. For this, we first need to figure out the number of ordinary shares that we have. Okay, we have share capital right here. That's 200,000, and our nominal rate is also given to be 1. In order to calculate the number of ordinary shares, we just divide our value of ordinary shares by the nominal rate, which in this case gives 200,000. So we need to calculate the corresponding bonus shares for 200,000 ordinary shares. We will be applying the unitary method. For 200,000 ordinary shares, we need to provide 1 by 10 times 200,000 bonus shares, which will be 20,000 bonus shares. And remember that bonus shares should always be issued at the nominal rate, since we are going to fund it by our reserves. So 20,000 will be added to our share capital. You can just remember the format for our statement of changes in equity. So we are following a similar process. We add 20,000 to our share capital. We need to subtract the same amount from our reserves. The first reserve that we utilize is our share premium reserve. And this has the amount of 14,000. So that's lower than 20,000, which means that we can only subtract 14,000 from this amount. But we still have remaining 6,000 to fund. And that will be funded by our retained earnings. So we need to subtract 6,000 from the retained earnings. That's all for our bonus issue of shares. Okay. Then at 30 September 2023, this is our closing date, irrecoverable debts of 1,480 were to be written off. Okay. So irrecoverable debts should be shown as part of our overhead. So we need to include this within our administrative expenses. That will be 1,480. And remember that irrecoverable debts should also be subtracted from our trade receivables while showing its value within the statement of financial position. So we can just subtract 1,480 right here from trade receivables. Okay, then the directors propose to maintain the allowance for irrecoverable debts at 5% of trade receivables. Okay, and remember, while calculating the allowance for irrecoverable debts, we need to subtract our irrecoverable debts first. So the given value is 82,680 minus the irrecoverable debts of 1,480 multiplied by 5%. This gives the allowance for irrecoverable debt to be 4,060. And remember, the closing allowance for irrecoverable debt should also be subtracted from trade receivables while showing its value within our statement of financial position. So I'm just going to subtract the 4,060 here as well. Now we need to compare our closing allowance for irrecoverable debts to our opening allowance for irrecoverable debts and figure out whether there has been an increment or a decrement. We were given the allowance for irrecoverable debts at the opening date right here. That was 3,820, which is lower than our current amount, which means that there has been an increase. So the increment is a 4,060 closing value minus the opening value of 3,820. So 240 is the increment in allowance for irrecoverable debts, which we should treat it as an overhead. So again, we need to add this amount to our administrative expenses. All right. We're done with 1 and 2. Then depreciation was to be charged for the year ended 30 September 2023. We have already adjusted the depreciation. Administrative expenses of 2,480 were owing. So this just means that we still need to pay 2,480. This will act as our payables. So we need to add it to payables as well as we need to add it to our administrative expenses. Even though this amount has not yet been paid, this is the expenses incurred in the current year, which we need to show as part of our overheads within the statement of profit or loss. Let's write it down. So this will be included in our other payables. That's 2,480. Then we also need to add it to our administrative expenses. Okay, that's all for the fourth one. Then distribution costs of 750 were prepaid. This just means that we have already paid the amount of 750, but this is not the expenses incurred in the current year. So we cannot show this as our distribution cost for the current year, which is why we need to subtract it. Then the 750 is prepaid, which means that we've already paid for it, but are yet to receive the services for it. So the 750 will also act as other receivables. So we need to add this amount to other receivables as well. So for other receivables, that will be plus 750. And within our distribution cost, that will be minus 750. Okay. That's all. Then the debenture interest for 5 months was owing. So this should be adjusted within our finance cost, and debenture interest relates to our debenture. We only need to calculate the debenture interest for 5 months. So we start with the amount of debenture, that's 60,000. We multiply it by the rate of debenture, that's 8%. But this will give the debenture interest for the entire year. We only require the debenture interest for 5 months. Again, we apply our unitary method. So we just multiply 5 divided by the total months of 12. And this will give the owed finance charge to be 2,000. And since we are yet to pay this, we can include this as part of our other payables. So that's plus 2,000. And we also need to include it within our finance cost right here. That's plus 2,000. Okay. Then the charge for taxation was estimated to be 12,500. So this is just the given information. We do not need to adjust it anywhere. That's all for the information. Now, for the first part, we need to prepare an extract from the statement of profit or loss for the year ended 30 September 2023, commencing with the gross profit for the year. So we have been given the value for our gross profit. Let's write it down. That's 321,070. Then we have also made all of the necessary adjustment to our distribution cost. So we can now just figure out its total. That will be 84,650 plus 7,620 minus 750, which is also 91,520. Then we have made adjustment to our administrative expenses as well. So let's figure out its total. That's 161,100 plus 11,430 plus 1,480 plus 240 plus 2,480, which results in the value of 176,730. Now we need to calculate the profit from operations. That is just going to be the sum of these three amounts. So 321,070 minus 91,520 minus 176,730, which results in the value of 52,820. Then we've also made the necessary adjustment to our finance cost. That was 3,950 plus 2,000, which results in 5,950. Let's write it down. So 5,950 should be subtracted. Now our profit before taxation is just the sum of these two amounts. So that's 52,820 minus 5,950, which results in 46,870. Then the amount for taxation was also given, which was 12,500. Let's subtract it. And our profit for the year will be the sum of these two amounts. So that's 46,870 minus 12,500, which results in 34,370. That is all for the statement of profit or loss for the year ended 30 September 2023. And we have been given the working section for distribution costs and administrative expenses. So you need to show this part and this part within your calculations or the working section so that you get your markings correctly. Now let's move towards the second part. We now need to prepare the statement of financial position at 30 September 2023, and we need to use the space provided to show the workings, but I have already made my adjustment in the given information. Okay, so we can start with our asset section. We can start with our non-current assets. And the non-current assets will only include the property, plant, and equipment. We need to include it at its net book value. Okay. So we were given the information regarding its costs and accumulated depreciation. The total is right here, but remember we have to subtract 15,000 from this so that we show the revaluation downwards within the net book value correctly. So the net book value for the non-current asset, we can start with this amount of 408,400. There's a revaluation downwards of 15,000. We also need to subtract the accumulated depreciation of 110,650, and we need to subtract the depreciation charge for the year of 19,050. This results in the net book value to be 263,700. Let's write it down. That's all for our non-current assets section. Now let's move towards the current assets. Okay. So within our current assets, we first need to include the trade receivables at the value of 82,680 minus 1,480 minus 4,060, which results in 77,140. Then we have, what else do we have? We have other receivables at the value of 940 plus 750, which results in 1,690. We need to include this. Then we have inventory of 74,000, and we have the cash and cash equivalents right here of 4,680. Yeah, those are our 4 current assets. Let's write it down. So we start with trade receivables. This had the value of 77,140. Then we had our inventory of 74,000. We had other receivables of 1,690, and we were given the cash and cash equivalents, which was a 4,680. Now we can figure out the total for our current assets by adding these 4 values. So that will be 77,140 plus 74,000 plus 1,690 plus 4,680, which results in 157,510. Now we need to figure out the total assets. So that will be the sum of total non-current assets and total current assets, which in this case is 263,700 plus 157,510, which results in 421,210. Now we can move towards our equity and liability section. We can start with equity. And within our equity, we had made some adjustments. And further, we also need to add profit for the year within the retained earnings column. Remember the format for statement of changes in equity. So we'll be adding 34,370. That's right here, 34,370. Okay. And remember, within the statement of changes in equity, the final thing that we adjust within the retained earnings column is the dividend paid, which is, yeah, right here, it's given to be 4,000. So we need to subtract this as well. Okay, so the final value for the retained earnings will be 45,850 minus 5,000 minus 6,000 plus 34,370 minus 4,000, which results in 65,220. This is a value to be included within our statement of financial position. Then the valuation reserve will be 0. Our share capital will be 220,000, and our share premium will be 0. So the only item within our equity section will be share capital with 220,000 and retained earnings with 65,220. Let's write it down. Okay, we have our share capital of 220,000, and we have our retained earnings of 65,220. Let's figure out the total. That will be 285,220. Now we can move towards the non-current liabilities section. And I think the only non-current liability we have is the 8% debenture. And this debenture is to be repaid in the year 2025 and has the amount of 60,000. Let's write it down. That's all. Now we can move towards the current liabilities section. Okay, so our current liability will include the trade payables at 57,150. Then we have other payables of 1,860 plus 2,480 plus 2,000, which results in 6,340. Then we have, what else do we have? Oh, taxation, because taxation was just estimated and we are yet to pay this amount. So this needs to be included as part of our liability as provision for taxation. Let's write it down. So the first one we had was trade payables of 57,150. Then we have other payables of 6,340 and provision for taxation of 12,500. Okay, let's see if we included everything. This is included. We've included the net book value of our asset. We included our finance cost, dividend paid, distribution cost, allowance, administrative expenses, debenture. Yeah, we included everything. So we can calculate the total for our current liabilities, which will be 57,150 plus 6,340 plus 12,500, which results in 75,990. Let's calculate the total liabilities. This will be the sum of total non-current liabilities and total current liabilities. In this case, that's 60,000 plus 75,990, which results in 135,990. Then we also need to calculate the total equity and liabilities. This will be the sum of total equity and total liabilities, which in this case will be 285,220 plus 135,990, which results in 421,210. And we can see that our total assets is equal to total equity and liabilities, which means that our statement of financial position is correct. This concludes the second part. Let's move towards the third one. Again, you are given the working section, so you need to show all of the workings for non-current assets, trade and other receivables, retained earnings, as well as trade and other payables within this particular section in order to get your markings correctly. And I have included all of the workings required for this section within the question paper itself, so you can refer back to it. Now we're given additional information. The directors wish to raise additional finance and they are considering two options. Option 1 is to make a rights issue of 1 ordinary share for every 4 shares held at a premium of 0.10 per share. Remember, our nominal rate is 1. And for option 2, we need to issue a further 8% debenture, which will be repaid in the year 2028, in order to raise the value of 50,000. Okay, so the cash value is given clearly for option 2. Let's calculate the cash value that we can make from option 1. This is 1 ordinary share for every 4 shares held. And remember, the total for our share capital is 220,000. So we have 220,000 ordinary shares. Now for 220,000 ordinary shares, we'll be providing 1 by 4 times 220,000 right shares. So that's just going to be 55,000 right shares. So the value of rights issue is just going to be the number of shares multiplied by the nominal rate plus our premium of 0.10. And this results in the amount of 60,500. Okay, now we need to advise the directors which option they should choose. This is a 5 marks, so we need to have 2 comments for option 1, 2 for option 2, and 1 final decision. Okay, so the first thing that we can say is that the rights issue will act as a permanent source of capital because it won't have to be repaid in the future, whereas debenture will have to be repaid. Let's write it down. Rights issue is a permanent source of capital whereas debenture will have to be repaid. Then the next thing that we can write down is for our right shares, we need to provide dividend, but the dividend payment is discretionary, which means that in the year that the company might go through a loss, and in such cases, the dividend payment is not required by law. But in case of debenture, interest must be paid whether profits or losses. Let's write it down. Dividend payment is discretionary, whereas interest on debentures will have to be paid regardless of profit or loss. Now, based on these factors, you need to make a decision. And in cases where you need to choose right share or debenture, personally, I would always side with right shares because interest payments will reduce the profits, whereas for right shares, the dividend payment is discretionary. Let's write down the decision. The directors should choose option 1 as interest payments for debentures will reduce profit. Alright, that is all for this question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.